Hi, thank you for joining us at Tax Talk UK. I'm going to talk a little bit about keeping your accounts. Before I do, if I could ask you to please take a second to subscribe to our YouTube channel and turn on the notifications. That way you'll easily be able to refer back to this information if you need to, as well as finding out other information on a whole wide range of topics, including taxes. And of course, you will then be notified of new guidance as we upload it. Thank you. So on to keeping accounts. What do I mean by keeping accounts? Essentially, I'm talking about maintaining the financial records of your business. It's also known as bookkeeping. So depending on your business type and activities and industry, this can become quite complex. There can be lots of rules and regulations to follow, to be aware of, and also to keep updated on. So it can, in these circumstances, it can be advisable to engage the services of a bookkeeper. And of course, you should make sure, if you are doing so, that they are qualified for the help that they are giving you. So there's no reason that you can't undertake at least some of the bookkeeping activities yourself, even if some of them are too complex and you don't feel comfortable with. In these days when a lot of us are already using Making Tax Digital software or working towards it, this makes it easier to learn how to do certain aspects of the bookkeeping. And you should be able to find a bookkeeper who will work with you to support you to be able to do the bits that you want to do yourself, that you have the time and the skills to make sure that they're done correctly and that they fill in the gaps and make sure that everything overall is correctly submitted to HMRC or via an accountant or yourself. Even if you outsource all of your bookkeeping or some of it, it's really important that you actually have an understanding of what's happening, of the finances of your business at all times. So even if somebody else is actually doing the bookkeeping for you, you should ensure that you understand what you're engaging them to do, what they are doing, and that you're getting regular feedback as to the financial health of your business. But ultimately, whether you undertake all of the bookkeeping and financial management of your business yourself, or you outsource everything to professional advisors, or whether you have something that sits in the middle, the most important thing is that ultimately those financial records are accurate, and that will mean that anything that's submitted to HMRC in terms of returns, whether it be tax returns, VAT returns, and payroll, anything that you might need to do, it's just really crucial that that's correct. Once mistakes enter into your financial records and filter through into returns, these quickly can accrue and become very, very costly, as well as the actual mistakes themselves in terms of the penalties that you can receive from HMRC for inaccuracies. So we do have separate guidance, which you can find both on our website and on our YouTube channel, where we talk about Making Tax Digital and how this can help you to maintain the records if you're not already mandated to comply with Making Tax Digital. And within that guidance, we also have guidance on how to use some of the Making Tax Digital software. And we look at the software provided by QuickBooks, Sage Business Cloud, Free Agent, and Xero. Regardless of how simple or complex your accounts and your activities are, fundamentally keeping your records will mean keeping accurate data on your sales and your expense and your expenditure, which they will form your profit and loss. You'll have your sales, your turnover often referred to as well, your cost of sales, your expenses or overheads, depending on the terminology used, and this will give you your profit for your business. And by accurately reconciling your bank statements, for example, reviewing your outstanding debtors, which is your customers that owe you money, your creditors, which is the money you owe to your suppliers, will ensure that you're accurately maintaining the records for your assets and your liabilities, and these will form part of your balance sheet. And as you may already know, that in terms of your expenditure and what you're claiming as business expense, the rules surrounding that it must be wholly and exclusively for business use, and on what documentation in terms of receipts and invoices that you will need to verify that in order to claim that as an expense, and the VAT element if you're VAT registered. So whether you manage your own bookkeeping or you employ a professional bookkeeper to do it for you, it's really important that on a regular basis, you are either running, if you're doing it yourself, or receiving, if you're engaging the services, the financial reports for your business. You should be looking at the profit and loss and the balance sheet as a minimum, as well as reviewing your debtors and your creditors. And these are known as management accounts. So in terms of the profit and loss, this will tell you how profitable your business is. So regardless of how much money you've got in the bank, how much profit you're actually making, as well as looking at the costs, you'll be able to see any opportunities for saving, anything you're perhaps paying a little bit more than you could be, to be able to increase the profitability by saving costs, and of course to make sure that your sales is covering all of the costs that you're incurring. The balance sheet will also show you what assets your profit is tied up in, and importantly whether your business is solvent, which in effect means that your assets are sufficient to clear all of your liabilities at any given time. As I mentioned earlier, you should also regularly be reviewing who owes you money. So these may be referred to as accounts receivable or debtors if you're using software, for example. But it all, in effect, it all means the same thing: who owes you money, who hasn't paid you for the sales that you've made. So depending on your business activities, it may be that your customers or clients pay you at the time of the sale, but if they don't, you should make it very clear on the invoice and on your engagement with them exactly the terms that you expect them to pay to. So how long and when exactly you expect them to pay, and then you should be giving them regular statements so that they can know how much that they owe you, and of course chase any late payments as soon as they become late. You should be chasing. It's really important that you let people know that they owe you money and that you have noticed. This in itself will to an extent increase the speed that you get paid. So late payments can be difficult to manage, especially if you know your customer or your client that owes you the money. If payment's late, you should establish if there's any reason for this. So check if there's any queries or disputes on the invoice. And of course, if there are any, that you respond to these promptly and professionally. But ultimately, if payment isn't forthcoming, you may need to consider taking some action to recover that money. So this can be quite time consuming and expensive. So you should weigh up if there's other avenues that you could explore. So for example, if your customer is struggling to make the payment, perhaps offer them a time to pay arrangement, which you can just organise between the two of you, which ultimately a court may order anyway, if you actually went to that extent, if you needed to recover the money. And then you should also regularly be reviewing the money you owe to your suppliers. So these may be referred to as accounts payable or creditors. And whilst it's good management to hold on to your cash for as long as that you can, it is important that you pay your suppliers promptly and certainly within the terms that have been agreed. And also prompt payment can do wonders for your ongoing relationship with your supplier for the future if you will need to be using them on a regular basis. So thinking then about cash flow. Cash flow refers to the actual amount of money coming in and out of the business, and it's entirely separate from profit and loss. It's really important that as a small business owner, you have an understanding of what is profit and what is cash flow, because to confuse the two can have some quite devastating consequences. So, for example, it would be easy to assume if you had a lot of money in the bank that your business was profitable, but perhaps all of your customers have paid you and you haven't paid any of your suppliers, and that actually your business isn't profitable. And likewise, you may not have very much money in the bank and maybe worried that your business isn't profitable, but it could be that it's tied up waiting for money to be paid. Perhaps you have an issue with your debtor control, or perhaps it's just simply tied up in assets. And whatever the scenario, it's important that you actually understand how this is in your individual business. So if we think then of a sole trader, a small sole trader operating a very simple service business, it's easy to see that if the customers pay at the time of the service, then pretty much the cash flow will follow the profit and loss. If everything's being paid to the business at the time that it happens, at the time of sale, and everything is being paid out at the point of the purchase, then of course profit and loss would be followed quite closely by the cash flow. But let's then add in something quite basic like VAT registration, and then this illustrates how the two start to part ways. So when that sale is paid for of a VAT registered business, some of that will include VAT that needs to be paid to HMRC. So the VAT may, generally, your VAT return would be completed, say, quarterly. So you would have to hold on to that VAT that you've received until you make that payment to HMRC. So although the money's in your bank account, it's not actually part of your, but it's part of your working capital, but it's not the profit of the business. And similarly, when you've paid the money out, some of that payment is VAT, if you're a VAT registered business and it's a VAT supply, and you're going to recover that within your VAT return. So again, the difference between the two, you're going to have to hold on to, or you're not going to get it back for until the end of the VAT quarter. So then it quickly becomes clear, if we think about that, how then the cash flow in that scenario isn't so closely following the profit and loss, because we have the VAT only happening every 3 months, for example. And this shows, when I mentioned earlier that if you have money in the bank, it can feel like the business is very successful. This is why it's important to have an eye on your balance sheet, so that you know what liabilities may be earmarked from that money, or whether it is actually profit that is retained within the business. So on that simple example, let's build in now that as well as that business being VAT registered, so they have to account for when they have to pay the liability or receive any repayment from HMRC for the VAT. Let's imagine that they have an employee who's paid on a monthly basis. So now, out of that sales money coming in and what's left after the purchase has been paid for, the business owner must also make sure that by the end of the month there's enough money in the business to be able to pay the employee their wages, as well as the associated cost to HMRC and any pension payments. So again, the more factors that we introduce, the further that the cash flow it departs from the profit and loss. So then if you also enter in credit terms, both for your own customers and suppliers, you then have a delay between when you make your sale and when you receive the cash for it, as well as the same on purchases going out if you introduce terms. So all of these things, it becomes clear to see why profit and loss and cash flow don't generally follow each other unless you have the most simplest of businesses with no complexities. So if I hop onto our website, and I will put the link to this page in the description if you want to have a look at it, I just wanted to show you a basic forecast that you can use for your cash flow. So this is actually from a spreadsheet, which obviously can be great because you can put the formulas in. You can actually download from Microsoft Excel a template. The only word of caution, if you're designing your own and you're putting formulas, please do check that they work, because the last thing you want to do is to design a complex cash flow or even a basic cash flow forecast, rely on the figures and find that there's an error in the formula. So just please do make sure that the formulas do work if you're using a spreadsheet. So a cash flow forecast then will help you plan ahead to ensure that you will have the money available to meet your liabilities as they become due. There is software available to help you with this, or you can use a simple spreadsheet. Either way, you need to forecast the money you expect to come in and the money you expect to come out, and this will then show your expected balance at the end of each period. You should remember to record the time that you will receive and spend money, which may be different to when it is incurred. So we've already gone over that in a little bit of detail to establish why the cash flow is not necessarily the same as the profit and loss. So month by month in this scenario, you may decide that you need to do a weekly cash flow or a quarterly cash flow. It will be very much determined by your particular business, what you need to know, any particular issues, what stage of your business, and how your business is doing, or if you're having any particular issues. So you would decide that yourself. So basically for each period, we would show in the top section a list of the different types of income that we'd expect, all the money that we expect to come into the business from any sources, whether it's anything to do with your profit and loss or your balance sheet. So for example, you'll notice here that we've got cash sales and credit sales. Now that is because of course the cash sales are the sales that you're going to be paid for straight away. So if in January, for example, you make a cash sale, then the money you would expect to come in. So therefore that would be reflected by what you expect in your profit and loss for cash sales. Your credit sales will be determined by your credit terms. So if, for example, you give your customers or clients 30 days or in effect a month to pay, then those sales that are made in January, you wouldn't expect to see the money coming in until February. So you would put them in that column. Then you would also look at any, if you were looking at borrowing money, any loan money coming in, if you was expecting to receive money back from HMRC for a VAT return where you've spent out more on VAT than you've paid, or perhaps you may have to put some money into the business from yourself. Literally any money that you expect to come into the business should be recorded in your cash flow forecast. So then moving down to the payments, we do exactly the same for anything we expect to go out of the business. So again, when we look at our purchases, we're going to be looking at, cash purchases, so things that we pay for there and then would go in the month that we expect to make them. But anything where we have any credit, if we don't expect to pay them, for example, until the next month, they would go into the next month. Sometimes you may have to look a little bit more closely. Say, for example, if you have terms of 7 days, then that would determine when you made it in the month. So that just the best that you can. And what you have to remember is that a cash flow forecast really is an estimate, because until those things happen, you can't be certain. So you can't say entirely that none of your customers are going to pay you early and none of them are going to pay you late. They're not going to pay you all bang on the day that they're due. So it is, to some extent, it is an estimate. So what you will find is that when you first start to look at your cash flow forecast, it may feel like a complete stab in the dark in terms of your estimates. But the more that you do it, and then you review at the end of that period, you review what actually happened in terms of your cash movements, then oh yes, I forgot about that, or you know, I should have taken that into account, and then you can adjust your cash flow for the remaining periods that you've done, for anything that you realise that, you know, needs to be a bit tighter. You don't especially need to go back and once the period's ended, because then that becomes about the accounting and your profit and loss. So there's not really a lot of value in going back and changing your cash flow, unless you want to use that as a tool to help you learn and develop your cash flow tools. So we looked at earlier the basics of accounts in terms of your profit and loss is your sales less your purchases and your expenses. Your balance sheet is your assets less your liabilities. So it's quite basic, and it's really important when you're designing how to keep your accounts and how much to break down, for example, how much detail to give, how much to break down your sales, to make sure that you don't overcomplicate it to the point that it's so complex that you either don't understand it or it takes you a ridiculous amount of time out of proportion for the information that you're going to get. So a simple set of accounts that actually are valuable to you and within your business and help you manage the financial management of your business is far more valuable than a complex set of accounts that you're not going to look at because you don't really understand them. So if you engage a professional to help you with your accounts, whether it be a professional bookkeeper to cover your bookkeeping, or an accountant to submit your returns, the chances are you will come across and you will hear a lot of jargon. So sometimes it's just the fact that you don't understand the words and the language that's used in that jargon, and actually that it is a lot more simple than you realize. So I'm going to just pop over to the website again and run through some of the basic jargon that you might hear used, just so that you can understand what is being referred to. Although, of course, at any time you can ask your professional, and I'm sure that they'll be very happy to explain what they're referring to. So let's just run through some of the common things that you might hear. So profit and loss is the income and expenditure of your business, often referred to as income, or often sectioned, as income, also known as turnover. Then the cost of sales, such as materials. Taking cost of sales from turnover gives you gross profit, and then deducting your overhead expenses gives you your net profit before tax. Overhead expenses, broadly speaking, are the costs you would still incur regardless of the volume of your sales. That your balance sheet is the assets, so what your business owns or is owed, and the liabilities, what your business owes. A solvent business, put simply, will be able to pay all of its liabilities with the assets that it has. So you would be expecting to see in the difference and the bottom line of the balance sheet, which is the assets less the liabilities, a positive figure. Trial balance then is a list of all of the ledger codes and their respective balances for the period represented in 2 columns, debit and credit. So ledger codes, just to clarify, would be, if you're using software, for example, would be the different categories. So we have debit and credit listed for the trial balance. Traditionally, in manual bookkeeping, these would be painstakingly calculated from all of the transactions, but today software can take out a lot of the time involved. The trial balance figures are what are used to produce the profit and loss and their balance sheet. Each line on the trial balance will go on to either one or the other, and the column it is in will dictate where it goes. You may hear reference to taking accounts to trial balance stage, and this simply means collating all of the day-to-day transactions either manually or in software to the point where a trial balance is produced. This would then be adjusted as or if necessary prior to producing the final accounts. Cash flow, as we've already talked about in some detail, is the cash in and out of the business and the timing that this happens. It's very different from profit and loss, and regular review should ensure that you always have sufficient money to pay your liabilities when they become due. Or if you don't, you have advance notice of an issue, often referred to as a cash flow issue. Assets are what the business has, what it owns and what it is owed. Physical assets such as buildings, vehicles and machinery are known as tangible assets. Current assets are cash or money that can be turned into cash quickly, such as bank balances. Any money owed to your business is also an asset of your business, as is any stock that you have purchased but not yet sold. Trade debtors, also known as accounts receivable or creditors, are payments that you are owed by your customers. Trade debtors, also known as accounts receivable or outstanding customers, are payments that you are owed by your customers or clients. Debtors are payments that you are owed. Sorry for the confusion there. Liabilities are what your business owes to suppliers, HMRC, for example, in various taxes, or loans that you've maybe have taken out. Trade creditors, also known as accounts payable, are payments that you owe to your suppliers. Creditors are payments that you owe. Reconciliation is the process of comparing records in your accounts with official sources, such as statements. For example, you would want to ensure that you reconcile your accounting records to ensure that the bank transactions included match your actual bank statement. And this is referred to as the bank reconciliation, for example. Drawings and capital introduced are terms relevant to a sole trader. When you withdraw from or add money to the business, remembering that a sole trader means there is no distinction from the business and the owner. Therefore, these are simply movements between the business and the business owner. If you are trading as a limited company, then the business is a separate entity to the owner or owners, and you will hear terms such as director's loan, which is the money that you have put into the business, which is to be repaid when appropriate. Dividends are the distribution of the profit after tax to you as a shareholder. You may also receive a salary, which is an expense of the business and will reduce the profit. Share capital is your original investment into the company to purchase the share or shares. So typically for a micro entity, and the audience that will be watching this guidance, typically it may be £1 or £100 for a new small company set up, but it can be any amount that's appropriate and any number of shares. So as always, just a general brief overview as to keeping accounts, the kind of things that you should be aware of, whether you're carrying out your own bookkeeping, some of your own bookkeeping, or you have professional help. But as always, if anything doesn't make sense and you're not sure and you're struggling, then I would always advise that you get some professional help, because as we have talked about, errors can be and inaccuracies can be costly, both in the actual error itself, especially if it's compounded over time and keeps recurring, as well as penalties that you will receive if incorrect data and accounts kept mean that incorrect returns are submitted to HMRC. So hopefully that this will have been helpful to you. And as I mentioned, if you haven't already, please do subscribe to our YouTube channel. Thank you for watching. Goodbye.